The Federal Reserve's FOMC meeting convenes this week, with markets widely expecting a hold on rates, likely to the White House's renewed frustration. Yet, just as a consensus for rate cuts within the year has solidified, Macquarie has put forward a contrarian view. The Fed's next move could be a hike, not a cut. This assessment has widened the divergence in market views on the future interest rate path. The outcome of this two-day FOMC meeting is almost certain. Powell is highly likely to announce that the federal funds rate will remain in the 3.5%, 3.75% range. The CME FedWatch tool indicates just a 2.8% probability of a rate cut at this meeting, making even a symbolic 25 basis point reduction nearly impossible. This is another disappointment for the White House, which has been eagerly hoping for rate cuts to aid the economy, though financial markets have long priced in this expectation. The core market divide lies not in this week's decision, but in the interest rate path for the remainder of 2026. Previously, most economists believed the Fed would ease further with rate cuts this year, based on three premises. First, the labor market had shown signs of softness. Second, the inflationary pass-through effect of White House tariff policies was seen as limited. And third, Powell's scheduled departure this spring, with a Trump-nominated successor highly likely to be dovish, an explicit demand from Trump himself, making further easing seem a predetermined course. However, Macquarie has bucked the trend and thrown cold water on this view, offering a starkly different assessment. The Fed could opt to hike rates in the fourth quarter of this year. Two of the bank's North American economists stated plainly that the core of this view is a rebounding U.S. labor market, with unemployment set for a trend decline. They acknowledge the sole risk lies in a potential policy pivot led by a new dovish chair, but believe this risk is hedged as the incentive structure changes for the new chair once in office. Macquarie's call is also grounded in the theory of interest rate normalization. Post-pandemic, the Fed had raised its benchmark rate sharply to 5.5% to curb inflation, ultimately achieving an economic soft landing. Pre-pandemic, the rate hovered around 0.25% for an extended period, and markets had widely expected rates to fall back towards pre-pandemic levels, such as around 2%. But Macquarie argues that persistently, strong U.S. economic growth and inflation remaining above the 2% target suggests the neutral interest rate may be higher than Fed officials previously estimated. This issue may also be a key focus of Powell's press conference this week. Of course, the rate hike view remains a minority position for now, with mainstream institutions still firmly holding on to expectations for cuts. Goldman Sachs, for instance, forecasts the Fed will deliver its first 25 basis point cut in June and a second in September, lowering the target range to 3%, 3.25%. However, Goldman also cautions about risks. If the labor market stabilizes as expected, the urgency for further cuts would diminish significantly, and it will take some time for inflation to fall back to levels that would forge a consensus for cuts within the Fed. Bank of America has been more definitive, stating that Powell is highly likely to reiterate a wait-and-see stance this week, but this will certainly not evolve into a signal for rate hikes. The Buffet team argues that the current U.S. situation, a weak labor market coupled with elevated inflation, represents a relatively stable equilibrium, and the balance of policy risks has not shifted. Moreover, with the current policy rate near the Fed's own assessed neutral level and the economy facing a looming large-scale fiscal stimulus shock, the Fed is in no rush to act. In their view, a rate hike triggered by either a surge in inflation or an overheated labor market would be the market's biggest surprise this year, and the FOMC currently has no desire to keep that option on the table. Ultimately, the current market divergence over the Fed's rate path stems from differing judgments on the future trajectory of the labor market and the level of the neutral interest rate. For investors, the imperative is to closely watch three key signals going forward. First, marginal changes in U.S. employment data, which form the core basis for Macquarie's hike call. Second, the pace of inflation's decline, which will determine the window for rate cuts. And third, Powell's messaging at this week's press conference, along with Trump's nomination moves for the next Fed chair. These two factors will directly set the overall tone for monetary policy this year.